Hey everyone, welcome back. We're doing a deep dive today into some really interesting materials that you sent over from a quantitative trading course you're taking.
Right.
And it's all about this AmiBroker software and this really cool coding template that they use in the course to teach people how to develop and test and refine their own quantitative trading strategies.
Interesting.
And it's I was really fascinated by this because the way they've set up this coding template is really interesting, and it's designed to help people create trading strategies that are not only profitable but also robust.
Yes.
Meaning that they can withstand the ups and downs of real-world trading.
It's like having a blueprint for your trading strategy.
Exactly.
Instead of a building or something.
And what's so cool about it is they break it down into these 6 key components.
Right.
You have option, market classification, signal, position, stop, and then Monte Carlo simulation.
Right.
So let's just start with option.
Sure.
I mean, I'm guessing that this is where you sort of set the stage, like how much money you're starting with and those kinds of details.
Yeah, you're laying the foundation. You're defining your starting capital, your maximum number of open positions at any given time, your commission fees, when your orders are executed,
Right. Yeah.
all of that really important stuff.
It's like all of the sort of the basic parameters that you would have to set up before you even start backtesting a trading strategy.
Yeah, and the reason that's important is because it makes your backtesting more realistic.
Yeah, okay.
You know, if you're backtesting with a $100,000 portfolio and you're only trading with $10,000, then you're not really going to get a realistic idea of how that strategy will perform for you.
It's almost like it's setting yourself up for success in a way, because you're making sure that your backtest is actually reflecting what would happen
in real life.
Yeah, you're not backtesting a strategy that assumes you're paying 0 commissions when in reality you're paying commissions.
Exactly.
Or that you're able to get in and out of trades with 0 slippage.
Right.
When you're not going to be able to do that in the real world.
Right.
So those parameters need to be set realistically.
Okay, that makes perfect sense.
Yeah.
So then the next thing is something that really jumped out at me, which is market classification.
Yeah.
And it sounds like this is where you sort of tap into the wisdom of the overall market trend.
It is.
Like, are we in a bull market or a bear market?
Right.
You know,
are we in a raging bull market or are we in a bear market?
Exactly. So it's sort of like looking at the big picture.
Yeah, you don't want to be buying stocks when the market is crashing.
Right. It's like deciding whether to go sailing on a nice calm day or, during a hurricane.
Yeah.
Exactly. It's important to look at those macro conditions before you even
start thinking about individual stocks.
Exactly.
So then and what's cool is they actually provide you with code in the course materials.
They do.
To actually help you with this.
Yes.
And the code that they use is it uses what's called the Set MTI,
right,
which is a specific indicator that they use to gauge the trend of the Thai stock market.
Exactly.
Okay, so we're not only just looking at the individual stocks, but we're also looking at the overall market environment.
Correct.
And that's
actually a really important thing to do.
So tell me a little bit about how the Set MTI works.
So the Set MTI is basically a moving average calculation applied to the Set Index.
Okay.
Which is
So the Set Index is kind of like the Dow Jones Industrial Average, but for Thailand.
Exactly.
Okay.
It's like the benchmark index for the Thai stock market.
Gotcha.
And so what the MAD-CD does is it looks at the relationship between 2 moving averages of the Set Head Index.
Okay.
And it helps us to see whether the overall market is trending upwards or downwards.
Okay.
So if the Set MAD-CD is positive, that suggests that the market is in an uptrend.
Gotcha.
And if it's negative, it suggests that the market is in a downtrend.
So instead of just jumping into a trade based on some signal that you see in the stock,
right,
you're also trying to see if the tide is going with you or against you in terms of the overall market.
You don't want to be swimming upstream.
Exactly. Okay.
So you want to make sure that the tide is with you.
They actually, in the course materials, they show how incorporating this Set MAD filter can actually dramatically change the outcome of a trading strategy.
It really can.
Okay. All right, I'm hooked.
Okay.
So we've looked at option, we've looked at market classification now.
Right.
Let's talk about signal. I'm guessing this is where the actual buy and sell rules come into play?
Exactly. Signal is where you define
Yeah.
the specific conditions that will trigger your trades.
Right.
So it might be something like
Yeah.
buy when the stock price crosses above its 200-day moving average.
Right.
Or sell when the RSI indicator
Yeah.
falls below 30.
Okay.
Or something like that.
So you're basically programming
Programming.
your trading robot with these specific instructions?
Yeah, you're setting clear, objective rules
Okay.
for when to enter and exit trades.
And what's cool is
Yeah.
they suggest incorporating the set MKC
Yeah.
into the buy and sell signals
Exactly.
as well.
Yeah.
So it's not just about the stock itself, it's also about the context.
The market context, yeah.
So it's sort of like,
Yeah, it's like having a safety net for your trades.
right.
You know?
You're kind of like, you're like market detectives now.
Yeah, I like that analogy.
We're not just traders, we're like market detectives.
That's great.
Okay, so now
Right.
that we've defined our signals,
Yeah,
the next thing we have to figure out is how much to buy or sell.
that's right.
So that's where position comes in.
That's where position comes
Ah,
in. Yeah.
Okay.
So position is all about determining your trade size.
Yeah.
So
Right.
you know how many shares to buy or sell.
Okay.
And that's going to depend on a number of factors.
Right.
Your account balance, your risk tolerance,
Yeah.
the strength of the signal itself.
Okay.
All those things are going to come into play.
And I guess also the maximum number of open positions that you set back in the auction section
Yeah.
is going to
That's going to influence your position size calculations as well.
right, because if you only allow yourself to have like 2 open positions
Right.
at any given time,
Right.
then you're going to have
They're going
to
to have to allocate more capital to each trade.
right.
Yeah.
Okay, so you mentioned before
Yeah.
that they actually show in the course materials like how this idea of market classification plays out in real trading.
They do.
Like, did it actually make a difference?
It does. Okay. So tell me all about it.
So they took a specific trading strategy
Okay.
and they back tested it
Okay.
with and without
Okay.
this set MKD filter.
Gotcha.
Yeah.
I'm all ears.
So,
Walk me through it.
okay. So they ran the strategy through 4 different scenarios.
Okay.
The first scenario was they tested it with no market filter at all.
Okay.
Just pure buy and sell signals based on the stock itself.
Gotcha.
And then they tested it with only a buy filter,
Okay.
meaning they would only buy when the set MKD was positive,
Okay.
indicating a bullish market.
Gotcha.
Then they flipped it and tested it with only a sell filter.
Okay.
So they would sell when the set MKD turned negative,
Okay.
even if the stock itself looked promising.
And then finally, they combined both the buy and sell filters.
Okay.
So they were only trading when both the stock signal and the set MTI aligned.
Gotcha. So it's like you're running this experiment
Exactly.
and you've got these 4 different test groups
Yeah.
and you want to see which one yields the best results.
Right.
Okay. So spill the beans. What did they find?
So when they ran the strategy with no market filter at all, it actually achieved a decent return.
Okay.
But it also had some pretty significant drawdowns along the way.
So it's kind of like a roller coaster ride, you know?
Yeah.
Some exciting upswings,
Yeah.
but also some pretty scary drops.
Exactly.
Right.
Now, adding the buy filter helped a little bit.
Okay.
It led to slightly higher profits and a better win rate.
Okay.
But the drawdowns
Yeah.
remained pretty much the same.
So it's sort of like it smoothed out the ride a little bit.
Right.
You know, you're not going to have those like super steep drops, but you're also not going to have those like super exciting gains.
Right.
Okay.
Exactly.
And then what about the sell filter?
Yeah. So here's where things get really interesting.
Okay.
When they tested the strategy with only the sell filter,
Okay.
the results were pretty surprising.
Okay.
The overall profit was lower,
Okay.
and the win rate actually went down.
So you made less money
Right.
and you won fewer trades.
Right.
That doesn't sound good.
On the surface, no. But here's the key.
Okay.
The maximum drawdown was significantly reduced.
So even though you weren't necessarily making as much money
Right.
or winning as many trades, you were actually safer.
Yeah, you were protecting your capital,
Gotcha.
which is ultimately the most important thing.
So it's kind of like you're prioritizing protecting your capital
Exactly.
over squeezing out every last drop of profit.
Exactly.
Ah.
You know, sometimes it's better to take a small loss
Right.
than to risk a big one.
Right. It's like you know when to fold your hand in poker, even if you think you might still win.
Right.
Okay.
Sometimes it's better to just walk away
Yeah.
and live to fight another day.
Exactly.
And so that's what the sell filter was doing. It was basically saying,
Yeah.
okay, if the market is turning against us, let's get out of here,
Okay.
even if we think the stock might still go up.
And then what about when they combine both the buy and sell filters?
So when they combined both the buy and sell filters,
Yeah.
that seemed to kind of give them the best overall result.
Okay.
They had the highest win rate.
Okay.
They had a strong net profit.
Okay.
And the drawdowns were significantly lower
Okay.
compared to not using any filters at all.
Yeah, so it's like you're getting the best of both worlds.
Right.
You're getting the profits, but you're also protecting yourself from those big losses.
Right.
Okay.
And that's really the key.
Right.
You know, it's all about finding that balance between risk and reward.
Now, it's important to remember, I guess, that these are just the results for one specific strategy and one set of market conditions.
Exactly. Your results may vary.
Yeah, your mileage may vary, as they say.
Right.
But I think the takeaway here is that this idea of taking into account the overall market trend through this set MACD can actually make a big difference in how your strategies perform.
Exactly. And that's why it's so important to incorporate market classification into your trading strategy.
It's like you've unlocked a secret weapon.
I like that. All right. So besides looking at just these performance metrics, they also provide some code in the course materials for actually visualizing the set MACD on your charts.
I do.
I'm all about making things visual, so I love this part.
Right.
So tell me a little bit more about that.
So visualizing your data can be incredibly helpful in understanding how your strategy is interacting with the market.
And the cool thing is with AmiBroker, we can actually plot this set MACD right on top of our price charts.
So we can actually see the market trend unfolding alongside the stock's price movement.
Right. You can see it all happen in real time.
And they actually use this really clever technique in the code. They use what's called a ribbon to plot the set MACD.
Right. So instead of just seeing a line, you're actually seeing these colored areas that tell you instantly whether the set MACD is positive or negative.
Oh, I see. So it's like you're filling in the space above and below the zero line with these different colors.
Exactly.
So it's like a visual indicator of whether the market is in a bullish or bearish phase.
Exactly. Think of it like a traffic light.
Yeah.
Green light, go.
Gotcha.
Red light, stop.
So when it's blue, we're good to go.
Yeah, when it's blue, it means the set MACD is positive. The overall market trend is favorable.
Right.
And when it's red, it means the set MACD is negative.
Okay.
And we might want to proceed with caution.
So it's kind of like a built-in market compass right on our charts.
Yeah, I love that analogy.
Okay, now I'm sure there's some clever code behind this visual magic.
There is.
So can we take a peek under the hood and see how it's done?
Absolutely.
Okay.
So remember how we had to temporarily swap the stock's price data with the set index data to calculate the set MACD?
Right.
Well, there's a function in AmiBroker called restore price arrays.
Okay.
That's crucial for making sure that our chart displays the correct information.
Okay.
Because
then you don't want your chart to be showing the set index instead of the stock that you're actually analyzing.
Exactly. Okay. So restore price arrays basically swaps that data back.
Gotcha. So it's like we borrowed these ingredients to make this dish, and now we have to return them to the pantry.
Right. Yeah. It's like cleaning up after yourself.
So it's like a cleanup crew.
Yeah.
Okay.
Exactly.
So the next line of code then is simply restore price arrays.
That's right.
Okay.
Yeah.
And then how do we actually create this ribbon plot?
All right. So to create the ribbon plot, we basically draw 3 lines.
Okay.
One at 0.
Okay.
And then one slightly above 0 and one slightly below 0.
Oh, and so you're basically creating this like channel around the 0 line.
Exactly.
Okay.
And then we tell AmiBroker to fill in the space between those lines with color.
Gotcha.
And that creates the ribbon effect.
So it's kind of like you're drawing a highway and you have these guardrails on either side.
Exactly.
And then you just paint the highway blue if the market's going up or red if the market's going down.
Right, exactly. And to create those lines, we just add and subtract a small constant value from our set MAC variable.
Gotcha.
So let's say we use 0.1 as our constant value.
So the upper line would be set MAC plus 0.1.
Exactly.
And the lower line would be?
And the lower line would be set MAC minus 0.1.
Gotcha.
Yeah.
And then you use those to create the plot.
And then we use those to create the plot using the plot function in AmiBroker.
Okay.
And we tell AmiBroker to fill the area between those 2 lines.
Okay, so the code would look something like this.
Yeah.
Plot. And then in parentheses, set MAC plus 0.1, comma, set MAC minus 0.1, comma, and then in quotes, set MACD ribbon, comma, color equals color blue, comma, style equals style area.
Almost.
Okay.
We need one more crucial piece.
Okay.
Which is that scale equals scale own setting.
Oh, right.
That we talked about before.
The separate speedometer for the car and the bicycle?
Exactly. So we need to add that in there.
So the final code would be plot, and then in parentheses, set MACD plus boring 1, comma, MACD minus boring 1, comma, and then in quotes, set MACD ribbon, comma, color equals color blue, comma, style equals style area, comma, scale equals scale own.
You got it.
All right?
And now, if you apply that code to your chart, you should see this beautiful blue and red ribbon flowing across your chart.
Good.
And it's going to clearly show you those shifts in the market trend.
Gotcha.
Based on the set MACD.
It's so cool. I love how you can actually visualize this stuff.
It's very powerful.
Yeah. It's like having this extra layer of insight.
Exactly.
Okay.
Yeah, it's like having X-ray vision for the market.
All right, so we've talked about option, we've talked about market classification, we've talked about signal, we've talked about position.
Right. You talked about stop.
Oh, right.
Which is all about managing your risk and protecting your profits. So we're not going to go into detail about that right now.
Okay.
But it's basically where you define your stop loss orders.
Right.
Your trailing stops, your profit targets.
And this template actually accounts for all that.
It does.
Okay. Yeah.
Cool. All right. So now the only thing left is this Monte Carlo simulation.
Right.
And I'm guessing...
And we haven't really talked about that yet.
Right.
But it's a very important part of the process.
All right. So let's dive into that after a quick break.
Yeah.
So Monte Carlo simulation.
So this is where we start to incorporate some real-world uncertainty into our testing.
Okay.
So up to this point, we've been assuming that we can execute our trades perfectly.
Right.
You know?
At the exact prices that we want.
We're assuming that we're going to get filled on every trade.
Right.
That we're never going to miss a trade.
Yeah.
That there's no slippage, and that's obviously...
That's not realistic.
Right.
So what the Monte Carlo simulation does is it allows us to run thousands of simulations of our trading strategy.
Right.
With slightly different variables each time.
Gotcha.
So we might introduce some random slippage into our trades.
Yes.
We might randomly miss some trades.
Right. Yeah.
And that's going to give us a much more realistic picture of the potential range of outcomes.
So instead of just seeing one like perfect scenario, we're seeing
the best case, the worst case, everything in between.
And probably like a bell curve kind of thing.
Exactly. It's going to give you a distribution of results.
Right.
And that's much more useful.
Okay, so how does this Monte Carlo simulation actually work?
So basically what it does is it takes your trading strategy.
Okay.
And it runs it through a bunch of random trials.
Right.
And each trials is going to have slightly different variables.
Right.
So for example, one trial, you might get filled on all of your trades at the exact price that you want on another trial.
Right.
You might miss a few trades, you might get some slippage, and so on.
And the computer is basically just like rolling the dice each time.
It's like flipping a coin.
Right.
You know, sometimes it's going to come up heads.
Yeah.
Sometimes it's going to come up tails.
Right.
And so by running thousands of these trials, we can start to get a sense of how our strategy is likely to perform.
In the real world.
In the real world.
Your real world.
Gotcha.
Yeah.
So this is super valuable information to have.
It is.
Because it tells you, not only what your potential upside is, but also what your potential downside risk is.
Exactly. And that's something that a lot of traders overlook.
Right.
They just focus on the upside.
Yeah, they just want to see those big gains.
Exactly. But it's just as important, if not more important, to understand the downside. Because that's the part that can really hurt you.
Exactly. You can recover from a small loss, but it's much harder to recover from a big loss.
Okay, so this has been an incredibly valuable deep dive.
Yeah.
I mean, we've covered so much ground.
Yeah,
we talked about, understanding the structure of this coding template.
Right.
We've talked about the power of market classification with this set MACD indicator.
Yes.
We've talked about visualizing it all in AmiBroker.
Mm-hmm.
We've talked about the nuances of optimization and how to avoid overfitting.
Right.
And then finally, we've talked about the importance of incorporating real-world uncertainty through these Monte Carlo simulations.
It's a lot to take in.
It is. It is.
But it's all very important stuff.
But it's all really fascinating stuff, and it's given me a lot to think about.
I'm glad to hear that.
Yeah. Thanks for being such a fantastic guide.
Of course, my pleasure.
On this journey through this quantitative trading course.
Happy to help.
And to all of our listeners out there, thanks for joining us.
Yeah, thanks for listening.
For this deep dive.
We hope you learned something.
Yeah, we hope you learned a lot and that you'll join us again next time. Absolutely. For another deep dive into the world of finance and trading.